Welcome to Tech Money Madness, your daily U.S. stock market deep dive. It is May 20th, 2026.
And man, it is quite a day to be looking at the markets.
It really, really is. I mean, our mission for this deep dive today is to, cut through the noise of what is honestly shaping up to be just a totally historic, intensely volatile market day.
Yeah, absolutely historic.
Right. I mean, we've got a huge stack of daily market briefings here, and the headline numbers, they are just flashing bright green everywhere.
Oh yeah, big time.
We're looking at the Dow soaring like an incredible 600 points and the Nasdaq rising 1.5%. But, those numbers, they're kind of masking a pretty brutal tug of war beneath the surface.
They really are. I mean, looking past those flashing green arrows is, well, it's the only way to actually understand what this specific type of volatility is signaling for you and the future of the economy.
Right. Okay, let's unpack this. We are going to look at three massive forces colliding today. So we've got geopolitical shifts literally redrawing the global energy map, a really shocking divergence in tech earnings, and then these counterintuitive moves from the Fed.
Right, because, a 600-point Dow rally feels fantastic. It feels like a victory lap. But a rising tide today does not necessarily mean the water is safe.
Right, exactly.
To understand the actual architecture of this rally, we have to look at the underlying global trends, the structural changes in how companies operate, and of course, the persistent shadow of inflation.
Yeah, inflation is always hanging over us.
Mm-hmm.
But we have to start with the geopolitical catalyst today, because the sheer relief flooding the market is directly tied to energy.
Oh, 100%. The energy landscape is driving this whole narrative.
Right. So U.S. crude oil prices have officially fallen below that, psychological $100 per barrel mark.
Which is huge.
It is. And the briefing outlines two big developments here. First, President Trump announced today that peace talks with Iran are in the final stages. And we are just neutrally reporting that announcement, but obviously the market is reacting to the de-escalation.
Exactly. Markets love stability.
And second, the UAE reported that a massive new pipeline, one specifically engineered to bypass the Strait of Hormuz, is nearly 50% complete.
And we really can't overstate how big of a deal that is.
No, we can't, because the Strait of Hormuz is essentially this 21-mile wide geographic choke point. Roughly 20% of the entire world's daily oil has to float through it. I always think of it like a massive grocery store that only has one open checkout lane.
That is a perfect analogy, actually.
Right. Like if one person's card declines or someone drops a jar of pickles, the entire store backs up. It's just this massive vulnerability. How does the UAE pipeline actually alter that risk for the global supply?
Well, for decades, the global economy has basically functioned with a knife at its throat, right? When you have intense friction in the Middle East, the market automatically prices in this massive risk premium.
Because they're terrified of the what if.
Exactly. Oil doesn't just trade on the physical supply we have today. It trades on the collective anxiety of what might happen tomorrow if a conflict shuts down that strait.
It's like an anxiety tax on the entire global supply chain.
Right. But the Iran peace talks provide this immediate, much-needed cooling off.
Mm-hmm.
And the UAE pipeline, that represents a structural long-term de-risking.
Because they're physically building a bypass valve.
Exactly. By building this overland route, they are fundamentally degrading the strategic leverage of that choke point. Even if tensions flare up in 10 years, the supply chain has an alternative route.
So traders are recalculating the future risk right now.
Yeah, they're realizing the threat of a sudden oil shock is basically being engineered out of existence. That's why the Dow is up 600 points.
Wow. Which, okay, brings us to the great paradox in today's briefing. Because the market is throwing this huge party over cheaper oil, but the Federal Reserve is, they are refusing to RSVP.
They are definitely staying home.
Seriously, moving from energy to macro policy, the tone just changes completely. Fed officials are signaling that a rate hike may still be necessary.
Yeah, the minutes from their recent meeting show a majority of officials anticipate raising interest rates if inflation remains elevated.
Wait, I have to push back on the Fed's logic here.
Go for it.
If U.S. crude just dropped below $100 today, and a structural fix for oil supply is half built, why is the Fed still so hawkish? Are they just looking in the rearview mirror?
It definitely feels that way to traders today, but if we connect this to the bigger picture, the Fed's caution makes a lot of sense.
Yeah, I guess so.
Well, the central bank knows that inflation isn't just a simple one-to-one reflection of today's oil prices. It's deeply rooted now.
Right. It kind of cascaded into everything.
Exactly. We had years of elevated energy costs. That bled into the cost of, manufacturing steel, shipping goods, harvesting crops. Companies passed those compounded costs on to consumers.
And then consumers, obviously, they had to demand higher wages just to survive.
Right. So the baseline for doing business fundamentally shifted upwards. And the Fed is looking at a completely fractured global economy right now.
Oh, like the U.S.-China trade war.
Yeah, perfectly good example. Major corporations are physically uprooting their manufacturing bases. They are moving factories away from the cheapest labor in China to more expensive allied regions.
Friendshoring.
Exactly. And rebuilding global supply chains from scratch is incredibly expensive. It's inherently inflationary. So they aren't looking in the rearview mirror. They're terrified that the natural resting rate for inflation is just permanently higher than their 2% target.
Man, so if you're a company right now, you can't rely on cheap loans anymore. You just have to become ruthlessly efficient.
That's the only way to survive.
And that leads us directly into the microeconomy, because corporate earnings are being completely reshaped by this desperation for efficiency. And it's pouring absolute rocket fuel onto artificial intelligence.
It really is. The bifurcation happening in tech right now is the defining market volatility story of the year.
Oh, without a doubt. We are looking at a true tale of two tech sectors today. An unprecedented AI hardware boom, and then just a brutal squeeze on legacy software.
It's a violent redistribution of capital, really.
Here's where it gets really interesting. Let's look at the hardware side first. Nvidia just posted earnings that basically defy gravity.
Those numbers were wild.
Wild. Non-GAAP EPS of $1.87, which beat by 10 cents. But the revenue, $81.62 billion in a single quarter. They beat forecasts by $2.65 billion.
Unbelievable.
And unsurprisingly, the top gainers today are all the physical infrastructure guys. Nvidia, Apple, Microsoft, Micron Technology, AMD. It's a gold rush, and they're selling the pickaxes.
Yeah, and the sheer volume of revenue flowing into those hardware companies points to a massive shift. This isn't just a software subscription boom, right? This is an unprecedented capital expenditure cycle.
Like actual CapEx.
Exactly. These titans are pouring hundreds of billions of dollars into physical reality. Concrete, steel, advanced cooling systems, warehouses filled with specialized silicon chips.
They're building AI factories.
They really are.
But then, you flip the page in the briefing and you look at Intuit, the massive company behind TurboTax. They just announced plans to cut 17% of their entire workforce.
Ouch. Yeah, that stock has been hammered.
17%, because investors are terrified that generative AI models are going to make traditional software completely obsolete. It's like Intuit is an established gold mine, and they just realized their customers bought a machine that finds gold for them automatically.
That is exactly the mechanism of disruption here. I mean, for 40 years, the value proposition was simple. Software is a tool. You pay a monthly fee, and it helps you do the work faster.
Right. You're the operator.
But AI isn't a tool anymore. It's an agent. It doesn't give you a better dashboard to do your taxes. It just does your taxes for you.
Wow. So the user goes from operator to, supervisor?
Exactly. And that means the whole legacy software business model is instantly overvalued. Why pay for a suite of software and a human to run it when one AI agent does it in 5 seconds?
And investors aren't waiting around to see if revenue drops. They're pricing that in right now.
Oh, too. That divergence, the euphoria in hardware and the sheer panic in legacy software, is the real story hidden inside this massive market rally.
It's totally an economic earthquake. And what's fascinating is that it's not just the 1990s legacy companies scrambling. Even the disruptors of the 2010s are radically altering their business models.
They have no choice.
Right. Like
Wow.
OpenAI is reportedly planning to confidentially file for an IPO as soon as this week, working with Goldman Sachs and Morgan Stanley.
Big institutional players.
Exactly. And the crypto market is explicitly shifting away from its, crazy hype cycle to focus on disciplined growth and sustainability. But the detail that really made me do a double take Airbnb.
Oh, yeah. The Airbnb news.
They just added new services today, including traditional hotels and car rentals. Wait, Airbnb is adding hotels. Isn't that the exact industry they were built to destroy?
It is.
What does this reveal about the life cycle of these tech companies? Have they just run out of ideas?
No, it's actually about the economic gravitational pull we talked about earlier with the Fed.
Yeah.
Think about the last decade. We lived in an era of zero interest rate policy, or ZRRP.
Free money.
Exactly. Venture capital could endlessly fund companies like Airbnb, Uber, and crypto platforms. They operated at massive losses just to acquire users.
Right. They basically subsidized the product to kill off their traditional competition.
Yes. But the moment the Fed raised rates and borrowing money actually became expensive again, the game changed. You cannot subsidize a revolution at 5% interest.
Oh, wow. That makes so much sense.
Right. To survive, these maturing companies have to show sustainable profitability. They hit a growth ceiling with early adopters, so to reach the mass market, they have to offer what the mass market wants.
Which is just a normal hotel room sometimes.
Exactly. And crypto platforms realize that to get institutional wealth, they can't act like financial pirates anymore. They have to act like traditional banks.
So the disruptors are basically putting on a suit and tie.
They are shedding their rebel identities to become the establishment. And it's making room for OpenAI to become the new apex predator of tech growth. I mean, what stands out to you as a listener when you see these companies completely changing their identities?
It's wild to watch in real time. It's really the corporate equivalent of like a teenager getting a mortgage.
Yeah, exactly. It changes your behavior
It
fast.
really does. And this harsh new reality of expensive money brings us to our final segment. We've talked about the high-flying tech titans, but if we look at today's list of market losers, it is a starkly different reality for everyday people.
The contrast is jarring. It's a completely bifurcated market.
Okay, let's put the lists side by side. The most active stocks absorbing all that capex today: Nvidia, Apple, Amazon, Microsoft, Alphabet. But today's top losers. Outside of Intuit getting squeezed, we have ELF Beauty, Wendy's, Target, and Netflix.
Which is basically the everyday consumer index.
Totally. It's retail, consumer goods, entertainment. I mean, the U.S. House even approved an updated housing bill today, sparking some hopes for affordability. The Dow is up 600, but Target and Wendy's are getting crushed. So what does this actually mean for the everyday consumer?
Well, it connects directly back to what we said about the Fed's inflation fears in segment 2. The declining revenue in these consumer stocks proves that the Fed's caution is entirely justified.
Because people are just tapped out.
Exactly. The average household is buckling under the weight of an economy that simply costs more to exist in, even with the Dow surging.
Right, because you can't buy an AI chip to reduce your grocery bill.
You really can't. When rent, insurance, gas, and groceries have been structurally higher for years, consumers eventually burn through their savings.
And they have to start making really tough choices.
Right. They trade down to store brands, they skip the Wendy's drive-thru, they cancel Netflix. A soaring Dow driven by $80 billion of hardware sales does not mean the average family's budget is healthy.
Yeah. The weakness in Target and ELF Beauty is just the market coldly acknowledging that the consumer is stretched to the absolute breaking point.
The shifting supply chains and inflation we talked about, this is the real-world consequence on Main Street.
Man, this has been an incredibly revealing journey through the briefing today. Let's synthesize exactly what we've extracted here.
Sounds good.
The global market is completely bifurcated. On one hand, geopolitical relief from the UAE pipeline is de-risking energy, and this historic AI hardware boom is pushing the indices to massive highs.
Right, the flashing green numbers.
But underneath that, traditional software companies are facing an existential threat from AI agents, forcing massive layoffs like at Intuit. And consumer staples are bleeding revenue because everyday shoppers are just crushed by sticky inflation.
And that nuance is really the essential takeaway for you today. A rising index doesn't mean every sector is soaring.
Not at all.
Navigating this economy requires understanding the massive gap between the companies building the future infrastructure, the companies being replaced by it, and the everyday consumer who is just trying to afford the present.
Well said. We covered massive ground today, from bypassing the Strait of Hormuz to Airbnb becoming a hotel broker. But as we wrap up, I want to leave you with one final lingering question to ponder on your own.
Oh, this is a good one.
With OpenAI preparing to go public and accelerate this technology even faster, which safe legacy industry will be the next one forced to slash its workforce like Intuit? The disruption of white-collar labor is definitely not ending. It is just getting started.
It's a sobering thought.
It really is. Thank you so much for joining us for this deep dive. Stay curious, keep questioning the headlines, and we will catch you next time.